pandemic has added urgency to finding a practical and durable solution to this intractable problem. I have here my colleague, Dr. John Wachi, Director of Research at the Institute of Economic Affairs, who was formerly a research person at the Bank of Ghana, where I also worked. Then he joined the International Monetary Fund, and then again he served in the Monetary Policy Committee. He will take us through the analysis of the issues and the search for result-oriented solution to stimulate the participation in the discussion. Dr. John Wachi, your audience, talk. Over to you. Thank you.
Thank you so much. Thank you so much for the introduction. I must say that monetary policy is not, that popular. It's not something that we talk about a lot. Fiscal policy seems to take the center stage. But we know that monetary policy has equally an important role to play in the economy, but to complement what the fiscal policy does. And the main purpose of monetary policy is to ensure price stability, and then also create a regime of low and stable interest rates, because these conditions are necessary to support growth and employment. Now, unfortunately, Ghana has experienced high rates of inflation and high interest rates for the better part of our economic history. And this situation has undoubtedly been inimical to a long-term growth and employment generation. The persistence of high inflation and high interest rates raises questions about the nature and effectiveness of monetary policy. Now, political leaders, the business community, researchers, and other stakeholders have expressed concern about the problem and have made calls to the Bank of Ghana to come up with effective solutions. Now, COVID-19 has added urgency to these calls as businesses and the economy struggle to recover from its impacts, along with the resurgence in inflation and the cost of living in recent months. So we are organizing this roundtable in response to the urgency to address this problem. The roundtable is also intended to promote a discourse on how to make monetary policy more effective in delivering what has obviously become an elusive objective of delivering low prices and then low interest rates. Now, we have brought together a diverse cross-section of stakeholders from government, parliament, I believe so, Bank of Ghana, the business community, banks, academia, development partners, think tanks, other CSOs, and the media to deliberate on the subject and come up with recommendations for the attention of policymakers. So I want to believe that we have this diverse cross-section of stakeholders here. We didn't have the opportunity to introduce ourselves, but I would be happy to have government representatives here, Bank of Ghana representatives here, members of parliament here, development partners, think tanks, the academia, and so that we can all, deliberate on this subject and get some kind of consensus. Now, my duty is to present a paper to guide the discussion, the roundtable. Now, the paper I'm going to present will cover first the design and implementation challenges that have faced the monetary policy. I will try to assess the performance of monetary policy in terms of achieving inflation and interest rate objectives, and then make some proposals to address the lapses that were identified in order to make monetary policy more fit for purpose. So first, let's look at some of the monetary policy design and implementation challenges. Now, historically, monetary policy in Ghana may be classified under two main phases. If you look at the evolution of monetary policy in Ghana, we can classify it under two main phases. These are the pre-2007 phase and the post-2007 phase. The pre-2007 phase is classified as the monetary targeting phase. And then the post-2007 phase, the inflation targeting phase, which we are implementing currently. Now, under the monetary targeting phase, the Bank of Ghana controls money supply directly as an intermediary variable towards achieving the final inflation target. That's how monetary policy under the monetary targeting framework, that's how it works. So up to 1992, domestic credit was the instrument that was used to control money supply. Then from 1992, Bank of Ghana shifted to the use of what we call open market operations, that's the sale of Bank of Ghana or government securities in order to control money supply. Now, under both cases, that is credit control and open market operations, now money supply targets were more often than not breached, largely as a result of physically fueled liquidity injections into the economy. This in turn contributed to inflation targets being breached as well. But as we will demonstrate below, the causes of high inflation went beyond these demand pressures, which are attendant to higher than targeted money supply growth rates that were experienced during the monetary targeting phase. Then come to 2007, Bank of Ghana adopted the current framework, which is the inflation targeting framework. Now, the adoption of the inflation targeting framework by Bank of Ghana, the IT framework, as was the same situation with other inflation targeters, was motivated largely by the judgment by the Bank of Ghana that the link between money supply and inflation had become increasingly tenuous. Now, this happens when an economy is evolving and structural and financial changes are taking place. Then the link is in economics. There's a link between money supply growth and inflation. Now, the bank came to the judgment that that link was becoming increasingly a slave. So they couldn't rely on the monetary targeting framework. Now, unlike monetary targeting, IT targets inflation directly without going through the money supply channel. The bank will normally use a broad range of information on the economy and then adjust its policy rate, which is a base rate for lending to banks. So that is the bank's operating instrument that is, adjusting. And this is supposed to influence banks' lending rates or the cost of credit. As a result, you expect demand for credit also to respond, and therefore money supply, and therefore aggregate demand, and therefore inflation. So that's how the process is. Now, IT is believed to enhance transparency and accountability in inflation management compared to monetary targeting. But to be effective, IT requires certain structural and policy conditions to be in place. First, you need a fully developed financial system that is efficient and comprises highly competing institutions. This is required for the smooth transmission of monetary policy impulses. In Ghana, as in many developing countries, the financial system is not fully developed. And this makes the transmission of monetary policy rather slow. That is the reason why when Bank of Ghana adjusts the policy rate, you don't see lending rates responding readily. They do so, but maybe after a lag. And then they don't adjust to the full extent to which Bank of Ghana adjusts the policy rate. So that's the first that is not entirely met in Ghana. Then second, the central bank should have sufficient autonomy to be able to make its own independent decisions without much interference from the treasury, that's the government. Now in Ghana, we can probably say that to a large extent, the Bank of Ghana meets this requirement as autonomy is conferred on it by the Bank of Ghana Act or Act 918. And we can assume that the bank makes independent policy decisions. Further, Bank of Ghana's financing of the budget has been restricted in recent years to prevent the kind of inordinate financing of the budget that prevailed under the previous monetary targeting phase. Now, the third requirement the third condition that is required of inflation targeting is fiscal discipline. This is key to reduce physically induced demand pressures that tend to undermine monetary policy. Now, this condition, we know does not prevail in Ghana because we have significant demand pressures emanating from financing of persistent high fiscal deficits. Now, the fourth requirement is that your exchange rate should be sufficiently flexible so that it can help in absorbing some of the shocks to the economy. And that takes some pressure off the policy rate. Now, in Ghana, we are classified by the IMF as operating a flexible exchange rate regime. But we know that flexibility is limited because the Bank of Ghana actively intervenes in the market to stem what it considers to be inordinate depreciations. Now, the inclination by the Bank of Ghana to stem exchange rate depreciation by intervening in the market renders the exchange rate a de facto secondary target of monetary policy, which undermines the process. In other words, whilst inflation is the final target, objective for monetary policy, at the same time, the Bank of Ghana has its eyes also on the exchange rate. And so it's like double targets. The bank has some kind of double targets to meet. Now, the fifth condition is that initial inflation, when you adopt inflation targeting, your starting point, you should start from an initial point that's with a low inflation, reasonably low inflation. Now, this condition was not in place as Ghana adopted inflation targeting in 2007. And I'll refer you to a table, on the screen. This is a table showing inflation targets, countries that have adopted inflation targeting as of 2015. This was captured as of 2015. Now, you will see that Ghana, I don't have a pointer, but I hope you can read it. Ghana is on the right and somewhere after Armenia. I don't know whether it's clear. You can read it. Yeah, if you look through all the countries that have adopted inflation targeting right from 1990 all through to 2015, look at the target, inflation target set by Bank of Ghana, 8.5 plus or minus 2. That is the highest amongst all inflation targets. You will see that some have as low as 1 to 3%, 2 plus or minus 1, and so on. And Ghana has the highest. And Ghana, of course, chose this very high inflation target because at the time that we adopted inflation targeting, our prevailing inflation was equally high. It was then 10.9%. So with that, actual inflation, we couldn't have set a target that was, fairly, low. Of course, we could have been more ambitious in setting the original inflation target. The target, as I said, was high because our actual prevailing inflation at the time was high. In fact, because high inflation has persisted subsequent to the adoption of our IT in 2007, the initial target has been changed only marginally to the current target, medium-term target of Bank of Ghana of 8 plus or minus 2%. So since we set the original inflation target of 8.5 plus or minus 2, we have come down only slightly to set a target of 8 plus or minus 2, which prevails right now. Now, there is another condition which inflation targeters should meet, and that is that you should have reliable data to work with. And then your model, forecasting model should be quite comprehensive. Now, data adequacy and reliability cannot be said to be the best in Ghana. So we have limitations, because your decisions are based on the forecasting that is done by your model. If your data is not reliable, then you can arrive at the wrong conclusions. So these were the initial conditions that faced us when we adopted inflation targeting. Almost all the important basic requirements were not in place. But somehow, the Bank of Ghana went ahead and said, we have adopted inflation targeting. Now, in fact, the IMF, because of all these deficiencies, the IMF initially expressed reservations about the adoption of inflation targeting by Bank of Ghana. Indeed, the IMF chose to classify Ghana's IT initially as IT light. In other words, not a fully fledged IT. That's how the IMF classified Bank of Ghana's inflation targeting framework. However, with the passage of time, somehow the IMF came around to endorse reluctantly a Bank of Ghana's IT, and we have continued to operate it till the present. Now, it is important to point out that even though inflation targeting does not control money supply directly, like monetary targeting, it is also a demand management framework. In other words, it is based on the theory that inflation is predominantly a demand phenomenon. Therefore, the IT seeks to control demand as a pathway to controlling inflation. The theory that inflation is a demand phenomenon, however, may be more applicable to advanced economies that do not face significant supply constraints. In those economies, controlling demand may be enough to control inflation. Now, in developing economies, however, supply constraints may be principal originators of inflation, while the demand may play largely a propagatory role. Therefore, apart from the inherent shortcomings of IT that we mentioned above, the framework is further inhibited in a supply-constrained developing economy like Ghana's. This is not to say that it is not necessary to control demand factors in developing economies. That's not what we're saying, but we are saying that if these do not originate inflation, well, of course, if they do not even originate inflation, the demand factors, they may generate what we call second round effects that may still have to be contained. Now, in Ghana, food prices, fuel prices, currency depreciation represent important supply or cost determinants of inflation. Now, food has remained a dominant part of the CPI basket, currently commanding a weight of 43%. Now, this means that on average, every Ghanaian, your total expenditure in a month, 43% of it goes to food, and then 57% goes to every other things. Now, in a more advanced economies, you won't spend 5 to 10% of your budget, monthly budget, on food. Here we spend 43%. So you cannot, take food out of your inflation equation. You can't take it out because it is such a dominant factor. Now we know that food production deficits and storage, preservation, and processing inadequacies, coupled with bottlenecks in getting our food to the markets, they make food an important determinant of the cost of living in the country. Then we have occasional shocks to oil prices, coupled with the multiple taxes and levies in the domestic price build-up. This represents a perennial source of inflationary pressure. Now we have persistent depreciation of the exchange rate due to the foreign exchange supply-demand gap. And this has been a constant source of inflation. Now, these factors that monetary targeting or inflation targeting may have little or no control over, these factors, these supply shock factors. So this is not to dismiss the role of demand pressures as we have indicated. Empirical evidence shows that demand pressures largely attendant to expansionary fiscal policies represent also a major source of inflation in Ghana. However, the point we are making is that demand pressures may not be the fundamental or exclusive causes of inflation, warranting the strict and exclusive application of a demand management, framework like the IT, like inflation targeting. Now, applying the framework to control demand, exclusive of considerations for the supply or cost factors, which unfortunately is what we have been doing all these years, could seriously erode the effectiveness of monetary policy. Now, as we demonstrate below, after nearly 15 years after we adopted inflation targeting, now monetary policy has unsurprisingly not been able to achieve sufficiently low and stable prices. Again, this is Ghana's inflation profile from 2000 to 2021. So that is over a 21-year period. And that is the corresponding graph. I hope you can see it. Now, truly, it is true that we have come down. We've been able to reduce inflation over the 20-year period from 40% to the current 12%. So that is a remarkable achievement. But I must say that if you look at this period, if you look at all other macroeconomic variables, they have all come down. So the macroeconomy and the management of it has certainly improved over these years. But the point is that even at 12.6% of inflation currently, it is not the best, because other countries have much lower rates of inflation than we have. And so let's go on to the next graph. It's a table, yes. We picked this table from the IMF Regional Economic Outlook for Sub-Saharan African countries. These countries are classified by IMF as middle-income countries in Sub-Saharan Africa. So they are our peers, Ghana's peers, okay? And if you look at the numbers, I mean, this is inflation going all the way from 2010 to 2022. The IMF has made some forecasts. So 2021 and 2022 are forecasts. Then on the last column there, we have taken the average, calculated the average for the entire period. And then, well, if you look at those numbers, I can say that Ghana is the third highest inflation country amongst the lot. In fact, we do better only than Nigeria and Zambia. Let's look at the graph. I think it's clearer on the graph. Okay. So if you look at the graph, it's the same table that we have graphed here. You will see that Ghana is the blue. I hope you can distinguish between the colors. Ghana is the blue that is third, somewhere hanging in third there. The graphs on top of Ghana on the average are Zambia and Nigeria. Then we rank third in terms of high inflation. All the rest, the other 7 or 8 countries are below us. And then in recent times, let's go to the next graph. Now, this is Ghana's inflation from 2019 to December 2021. Now, it will be recalled that Ghana Statistical Service replaced inflation in August 2019. So this is where we are taking the data from. The left, the very end on the left, that is where August 2019, that is when Ghana Statistical Service replaced inflation. And that caused inflation to drop significantly to just 7.8%. Okay. Now, that low inflation prevailed all the way through March 2020, and then COVID, took it up all the way to 10.6% in April, as you can see in the figure. Now, inflation remained elevated for a year until March 2021, when it dropped to 8.5%. And then inflation, it continued to fall to reach a trough of 7.5% in May. This drop was significantly influenced by food inflation, as we will show later. Because food inflation declined sharply to just 5.4% at that time. Now, since then, inflation has risen consistently to a record high of 12.6% as of December 2021. That's the figure there. In fact, the highest since rebasing was done in 2019. Now, the rise has been influenced to a large extent by food inflation once more, which has more than doubled from 5.4% to 12.8% over that period. Now, COVID-19, of course, has fueled inflation around the globe by driving up commodity prices through the disruption of supply chains. And this has been compounded by pressures from policy stimuli that have been implemented by governments to counter the impact of the pandemic. So indeed, both Table 3 and Figure 2 show the elevated inflation for most of the 11 sub-Saharan African countries that we showed. You'll see that all of them have seen their inflation go up due to COVID. Now, nevertheless, and this has happened to Ghana also. Nevertheless, as we have demonstrated above, Ghana's inflation problem is not a recent phenomenon. It has a long history. What the pandemic has done is that it has further exposed the weaknesses in inflation management in the country. Now, it is true to say that the recent surge in inflation has been fueled to a great extent by the food and fuel prices and exchange rate depreciation. Food production has been dampened by poor weather conditions, and prices have gone up. If you go to the markets, the evidence is there. Now, fuel prices have risen around the globe due to supply constraints. Ghana's currency has experienced marked depreciation lately due to flight of investor capital from the country, as well as other emerging markets following return to policy normalcy or tightening in some advanced economies. In addition to the unleashing of pent-up demand for foreign exchange for imports and travel, as policy restrictions began to be relaxed. Now, the higher exchange rate has fueled domestic prices of fuel and other imports. Now, it has to be recognized, however, that policy intervention to prop up economic activities and protect lives and livelihoods must have also fueled aggregate demand and inflation. But the key fundamental originators of Ghana's inflation that we discussed about, particularly food prices and the exchange rate, have persisted. Let's see the next graph, please. Now, this captures Ghana's inflation again from August 19 to October 20 to December. It goes all the way to December 21, and it is broken down into food and non-food, so that you see the contributions of those two components. Now, if you look at the table, please, let's have the figure next. So that is the figure that captures what is in the table. That is a plot of food prices, food inflation, and non-food inflation. By the way, the one on the top that is more volatile is the food inflation. And then the one that is more stable is the non-food inflation. So if you look at the graph, you'll see that over the last 7 months, when headline inflation has increased from 7.5% to 12.6%, food inflation has increased from 5.4 to 12.2. It is telling you about how volatile food prices have been, and to what extent they have influenced overall headline inflation. Then when you go to the next figure, where this is capturing the non-food components of inflation, the non-food components. So you have a housing, water being at the top. Now, this is capturing inflation as of December 2021, at a point in time, okay? And the components are broken down there. Now, you will see that housing, water, electricity, gas, and other fuel, the one on top, has inflation of 20.7%. So the point, and then if you look at transport, that is 17.6%. Okay, so you will see that even though we have headline inflation being just about 12.6%. When you go into the components, you will see that some of them have much higher rates of inflation. And this should tell us that as consumers, you see, we consume different things, as consumers. So some people may be facing higher rates of inflation than others, depending on what you consume. And I'll come to this later and when I come to my recommendations. In other words, I'll be suggesting that instead of using this universal inflation targeting framework where we just adjust policy rates to control demand and expect that everything will fall in line, we should rather go into the CPI basket and interrogate where the main sources of inflation are coming from and try and target those. So it's like, this is supplementary to what is being done now, but you adopt an additionally a micro approach in addition to the macro approach that you are doing. Okay, so that's what this figure is about. Then let's go on to the next. Now, this is showing us fiscal balances for sub-Saharan middle-income countries, which was also picked from the IMF Regional Economic Outlook. Now, I'm using this to make the point that I am not here suggesting that Ghana's inflation is entirely a supply-side phenomenon. I'm making the point that we should pay attention to the supply side, but equally to where the demand pressures are also coming from. And if you look at this graph, this table, which is showing fiscal balances for middle-income countries, sub-Saharan African middle-income countries, and the averages from 2010, the averages are on the far right. Now you will see that now Ghana has the highest average. Ghana is right on top, colored in yellow. The highest average for the period of 10.3% negative. Okay, so for the entire period. And I'm trying to make the point that, so Ghana's inflation, to the extent that demand pressures are maybe part of the problem, we can also point to the high fiscal deficits, as a source of inflationary pressure in the country. So it's not just supply side factors, but there are demand side pressures as well, especially coming from the fiscal policy. In fact, we know that in Ghana, there's empirical literature that confirms that fiscal policy is an important determinant of inflation. And we know that Ghana has had a very high, it's a high fiscal deficit country, as you can see from the graph. Okay, so that is the performance of monetary policy as far as inflation is concerned. And as I've tried to draw your attention to the way that we design monetary policy and how it is able to deliver in terms of inflation. Now, a related problem that we have experienced is the high interest rates or the high cost of credit in the country, which is also supposed to be an objective of monetary policy. So let's briefly go through the interest rate profile. Let's go to the next graph. Now, interest rates and the cost of credit have been quite high in Ghana. Now, this is the average lending rate profile. And now, of course, you will see that this is over a 20-year period, from 2000 to 2020. It was as high as 45, 47% 20 years ago, and it's now hovering above 20%. So it's come down. As I said, most of our macroeconomic indicators have all come down over this period. So it's not just interest rates. Inflation has come down. Interest rates have come down. Even the fiscal deficit, we may see that it's also come down. But we are not where we want to be. So let's go to the next graph. Now, the lending rate is the one that is of concern to us because that is the main determinant of the cost of the credit, the lending rate. So this graph is just telling us we have compared various interest rates and the spread between the lending rate and the other interest rate that we have shown here. So every height that you see there is a spread between the lending rate and the other rates. And the other rates are, this selected spreads. The other rates are the treasury bill rate, saving deposit rate, and then even inflation, we have it all there. Let's go to the next graph. Now, this is looking at the lending rate and monetary policy rate together. Now, the upper, all these interest rates that we'll be showing you, the topmost one will always be the lending rate. And all other rates are below it. Okay, so this is the lending rate versus the policy rate. Well, you can argue that they've been moving very closely together. Okay, now if we added some more frequency, then we could see the link more closely and whether even though they are moving together, whether there are some lags or not, and but because we don't have enough frequency and they are just annual data, that is how we see them so straight. But if we have more frequency, you see more variations, and then we'll see how closely they move together. Because we know that when Bank of Ghana adjusts the policy rate, the lending rate doesn't follow readily. There's a lag. Because we know that when the policy rate goes up, the lending rates follow more quickly than when the policy rate comes down. So there's that asymmetrical kind of relationship. Okay, so that is the policy rate and the lending. Let's go to the next graph. This is the lending rate and treasury bill rates. Again, the lending rates on top, treasury bill rates down. Now we can understand why lending rates, that's the rate at which banks lend to the private sector, the public. And the other one is the rate at which they lend to government. We can understand why the banks will lend at lower rates to government than the private sector. Because government, if you lend to government, it's almost risk-free. So that's why we have that relationship. I don't know whether you can say they are very close, or not. Then let's go to the next graph, which is again lending rates and saving deposit rates. And then you see the gap, the spread. While the banks are lending to the private sector at the top, according to the top graph, they are paying a pittance to depositors. So you see the spread. On the far left, it was 47 to 20 or something. It was as high as 20-something%. It has narrowed a bit, but this spread is still unacceptably high. And these are some of the things that we need to. All these are telling us that monetary policy is not effective enough in addressing what are many structural kind of issues. If you leave things to the markets, especially in a developing country context, we know that there can be market failures. So essentially what we have done is to leave everything to the market to determine for us. And the market is telling us that there are market failures. Let's go on to the next graph. Now, this is the lending rate again versus inflation. In other words, the banks will try as much as possible to maintain what we call positive real lending rates. But if you match it, if you go to deposit rates, if you were to match deposit rates with inflation, you will see that in some cases there will be negative, real interest rate, savings rates. But here they have ensured that the real lending rate is always positive. Okay. Now, finally, we have a selection of all the interest rates. The topmost one, as usual, is the lending rate. The policy rate is in there. The treasury bill rate is in there. Then right at the bottom is the savings deposit rate. And inflation is, so the lending rate is leading all of them. And that's what we are experiencing, the high cost of credit. Now, what are the causes of this very high lending rate that we are seeing? Now, we have extensively researched this problem. And I personally have been involved with monetary policy for a long time. I was a staff of Bank of Ghana. And then I was also a member of the Monetary Policy Committee. So what I'm doing here is not like I am criticizing anybody. I'm just making a contribution to what I see, underlying problems, inherent or persistent problems. So how can we all come together to address the issues? I've been an insider, and then I'm now an outsider. So I'm sharing my experiences. And I'm saying that from the evidence available to us, we can say that the causes of high lending rates are multifaceted. In other words, and that's the reason why inflation targeting alone has not been able and cannot resolve the problem. The approach must be, also multifaceted. Now, monetary policy affects interest rates generally. The policy rate is the overall benchmark for other interest rates. And the Bank of Ghana manages the policy rate in response to inflation signals. They raise it when inflation is going up and lower it when inflation is coming down. And then you expect bank rates, lending rates to respond. But now, we know that over the period that we have shown here, the policy rate was kept at an average of 18.5% for the entire period. Bank of Ghana policy rate averaged 18.5%. That is pretty high. And knowing that the lending rate will always be above it, okay, would you blame banks for keeping the lending rate also so high? When the policy rate itself has been equally high. I'm trying to make a point that the policy rate must also have influenced the lending rates somehow. Now, the policy rate is doing its work, in other words, trying to fight inflation. And therefore, it is being kept at that high level. And then the lending rate in response is also kept at that high level. Meanwhile, the lending rate averaged 27% over the period. So clearly there's a relationship, there. Now we also know, so that's the first point of call. I'm saying that Bank of Ghana's policy rates must also be influencing lending rates. That's one. Now we know that Bank of Ghana also imposes reserve requirements on banks. By the way, my colleagues, Bank of Ghana, is anybody here from Bank of Ghana? Unfortunately, today is the day that Monetary Policy Committee is meeting, starting their meetings. So unfortunately, we couldn't reschedule, we couldn't schedule this our roundtable earlier. And therefore it has to coincide. Today they are starting their meeting. So even though we invited them, I didn't expect those top officials who will be attending the meeting to be here, but I expected that they will send a representative. So Bank of Ghana imposes reserve requirements on banks. Are banks representatives also here? Oh my God. Okay, so the Bank of Ghana imposes reserve requirements on banks. It's now currently 8%. In other words, when you mobilize deposits from customers of 100, you have to deposit 8 in the Bank of Ghana. They don't remunerate it. They don't pay any interest on it, but it's kept in reserve. That's a cost to you because you are paying interest on 100 to the customers. Bank of Ghana says, come and deposit 8 with us. We won't pay you any return. It's a cost to banks. And you expect that the banks will also reflect it, in their lending rates. Not only that, Bank of Ghana also differentiates between foreign currency deposits and domestic currency deposits. In other words, when we deposit foreign currency with banks, and Bank of Ghana expects the banks to keep 8% with them, they require them to keep that in domestic currency, in cedis. Instead of dollar for dollar, Bank of Ghana says, if your customers are keeping dollars with you, what you deposit with the 8% should be in cedis. Now, that also brings in an additional cost of exchange risk, exchange costs, as the cedi depreciates. To the banks. The banks have said that, please, Bank of Ghana, let's match dollar to dollar. In other words, let's keep dollars with you, as we get customers' dollars. But this has not happened. So that's also a source of it. Now, so it is precisely to avoid the inordinate use of the policy rate to fight inflation with the potential to fuel lending rate that we propose above that Bank of Ghana pay attention to some of the supply side costs and so on. Now, when it comes to dealing with the lending rates, what do we do about it? What are the solutions? First, I must say that I mentioned the reserve requirements, and I said it's too high. I had proposed that we should at least reduce it to about 5% previously, and then allow the banks to match dollars with dollars. Now, the Bank of Ghana should also ensure the lending rates are high, partly because the customers, identification of customers is difficult. You can't credit the credit information on customers. It's not easily available. So the banks price this into their lending rates, the costs. So we need to strengthen those safety networks in the banking industry, especially customer identification, and so on. Now, I had suggested before that maybe there was a need to impose a ceiling between the lending rate and the policy rate. In other words, Bank of Ghana should probably say banks shouldn't lend above 5 percentage points. 5 percentage points above the lending rate, or 10%. Impose a ceiling like that. I have proposed that before, but I must say that that proposal was rejected by both Bank of Ghana and the banks. They were saying that, well, it will discourage banks from lending to the public, private sector, and create distortions in the financial and the banking system. So, in fact, I'm not going to go there again because that's something that we don't want to recommend again. Now, banks are also part of the problem in terms of the high lending rates. In other words, banks' operational and overhead costs are high. Inefficiencies in the banking system, and all of them, constitute costs which they pass on to customers. So the banks will also do well to, reduce their operational costs and inefficiencies so that they do not pass it on in high lending rates to banks. And then when we come to, government, government borrowing, it is also part of the problem. Government borrowing from banks instead of, well, the banks will prefer to lend to government instead of lending to the private sector, but that also drives up it crowds out the private sector and it also drives up interest rates, I mean, especially lending rates. And then the taxes, the multiplicity of taxes and the high taxes on banks, those are also costs to the banks, which, they pass on to customers. So government should also be able to, should make sure that the taxes, they do not charge inordinate taxes to banks, and that the taxes are proportionate and fair and all that. That can also help. And then government should also limit its borrowing. So these are the key reasons that the causes of high lending rates and some of the remedies, the solutions that we think can be found. And this has to be a joint effort by the Bank of Ghana, the banks themselves, and government working together. Now, if they do not work together and they blame each other, or or it's not government saying, Bank of Ghana, go and solve the problem. Bank of Ghana alone cannot address the problem. They will go and try and deal with it in the same free market kind of way. But this requires a visible hand, direct interventions to deal with the problem. That's what I do. But we have left it to the market forever, and we haven't achieved that result. So finally, let me come to my conclusion and recommendations. And I must say that we have provided a summary, a short summary, 3-page summary of the main conclusions and recommendations that we will give to you, the media, so that you can take that, because the whole presentation is a very lengthy kind of presentation, but we have summarized the key points and then especially the recommendations which we want you to put across. So I must just reiterate that high inflation interest rates have persisted for far too long in Ghana. And these have had devastating effects on growth and employment. Now, monetary policy, unfortunately, has been ineffective, largely ineffective in addressing this problem, precisely because it is not tailored to dealing with the fundamental causes. Now, we think that a new approach is called for to ensure that monetary policy is more fit for purpose. Now, one, as we have said, Ghana has a history of inflation persistence. This is the result of enduring supply or cost and demand factors, both. Because IT is largely an inflation targeting, a demand management tool, it is not fit for dealing with the entrenched supply or cost undercurrents of inflation. In particular, food price, fuel price, and exchange rate volatilities have been persistent drivers of inflation, but are not amenable to IT. Further, IT is equally inhibited in dealing with demand pressures because they are driven by an enduring fiscal deficit bias. So that one also must be dealt with. Otherwise, inflation is going to be difficult to control inflation. Now, a more comprehensive approach is needed to stem inflation on a durable basis. In particular, the Bank of Ghana should engage government and the relevant agencies to stem volatilities in food prices, fuel prices, and the exchange rate. A permanent solution should also be found for the persistent fiscal deficit bias through effective revenue enhancing and expenditure containment measures. Well, this is something that we have spoken on, in the past comprehensively. And if you want to go into it, it will take us away to a whole, whole big issue. Now anyway, I say something on the revenue side. There's several loopholes to the tax system should be plugged. And then on the expenditure side, rationalization and rebalancing are called for. Now, these are revenue loopholes that we've been talking about forever. If they were effectively plugged, even e-levy will not be necessary. Yes. And then also on the expenditure side, if you went there and then you looked at expenditure, is it the debate in this country about e-levy and so on? Most of the debate is on the revenue side. We don't normally talk about the expenditure side. If you go and look at what we are allocating our revenue for, you will see that there's a lot that can be done, there. Is it because if you say that let's raise revenue, let's raise e-levy and then spend it anyhow, there's a problem. Now, lending rates have been out of control in Ghana for years. This is the result of multiplicity of factors, including persistent inflation, high cost of monetary policy, banks' inefficiencies and high operational costs, high borrower risk, government incessant borrowing, and high bank taxes. Look at all the factors I've mentioned. If you don't address them, how can you deal with the problem? Now, the persistence of high lending rates is concerning because it has negative effect on investment growth and employment. And then given the multiplicity of causes, monetary policy alone cannot resolve it. The resolution must come from all the relevant parties, that we've mentioned. Now, Bank of Ghana, on its part, must ensure a more effective way of controlling inflation so that monetary policy itself does not fuel lending rates. Bank of Ghana must strengthen safety nets for borrowers, including through the identification and credit, worthiness schemes. Bank of Ghana must ensure strong oversight of the banking industry to engender efficiency and high standard of operation and to prevent collusive and customer capture practices that tend to sustain high lending rates and other financial charges. Banks, on the other hand, must improve their operational efficiency and reduce their costs to a minimum, including through modernization of their processes and systems and through strategic company focus and foresight planning so that these do not feed into lending rates. Meanwhile, government must restrain its borrowing to reduce pressure on lending rates by addressing the budget deficit bias. Government must also ensure that banks' taxes are not out of proportion or inordinate so that they do not overly overburden banks and therefore fuel lending rates. Now, finally, I'm looking forward to the monetary policy decision, the meeting and the decision. And this is something that I'll be doing on a regular basis, every 2 months. We want to, I'll put it out. It will not be every time a round table, but because I have come from the inside, and I know the workings and all that, I'll be predicting what the monetary policy decision will be every time. I'm not saying I'm always going to get it right, but I can give you those lotto numbers, from every 2 months. Now, the Monetary Policy Committee, I think, faces a difficult decision at this juncture. They are meeting from now till Friday. Now, in principle, the Monetary Policy bases its decision to adjust the policy rate on how the committee perceives to the balance of risk between inflation and growth. That's how they come by their decision. Now, on the one hand, inflation has risen consistently and sharply in the past 7 months, as we showed you, taking it well beyond the MPC target. The MPC target is 8 plus or minus 2. Inflation is now at 12.6, so it's well beyond that. And then the risk to the outlook, if you look forward, also seems to be on the upside, because food and fuel prices are likely to remain high. Meanwhile, the exchange rate faces uncertainty or upward pressure. Then on the other hand, there's evidence of a fledgling economic recovery, although the outlook seems crowded by an uncertain pandemic. Now, my judgment is that if I'm looking at the balance of risk between inflation and growth, my judgment is that the inflation risk outweighs the growth risk at this time. On that score, if you are looking at just that, you will say that the policy rate should be adjusted upwards to deal with the inflation. Okay. However, recalling that the policy rate, the Monetary Policy Committee increased the policy rate by 100 basis points just 2 months ago at their last meeting. Now the likelihood of another follow-up increase may be low, because normally when they hike the policy, they want to see it work itself through the system, for a while. Also, importantly, such a decision, of course, the Monetary Policy Committee and everybody has said, oh, we have been able to achieve very low, process of disinflation, and interest rates have come down generally and so on. So to start going up, the last time they went up on interest rates, on the policy rates, which the banks will also respond by also, and this time around also going up. I'm sure they will be concerned about that. So in the circumstance, my expectation is that the Monetary Policy Committee will try and play it safe by holding the policy rate at its current level of 14.5%. Now, this will allow the committee to buy a little bit of time until its next meeting in March, when a few more inflation readings would have come out and made the situation clearer. So by forecasting or predicting the policy rate, I don't think I'm doing anything wrong. Because I'm not a member of the Monetary Policy Committee, so I can speak my mind. So that's what I'm saying. So let's see what happens. They will announce it on Monday. Thank you so much. So sorry. Finally, sorry. Please, before you come in, finally. Please, the media, as I said, we'll give you a short write-up summary of the key points. Okay. Now, as I Monetary Policy is not a very popular subject, so I don't think a lot of people will pay attention to it, But the key media messages are that now we are saying that monetary policy has not been able to deliver its key objectives of low and stable prices and interest rates. That's what we are saying. Okay. Now we are saying that a comprehensive approach is required to control inflation. We are saying that to ensure low interest rates, we need the joint efforts of Bank of Ghana, banks, and government. No single entity can do it alone. And then we are predicting that the Monetary Policy Committee will maintain the policy rate at 14.5%. Okay, please come in, Mr. Moderator.
Okay, thank you, Dr. Pachi. For now, if any of the online participants, if there are questions, please read them. Let's see. There are some questions. Read them out so that we give them maybe 5 minutes.
No, so, I did. We started it.
Yes.
Okay, so,
if there is something you could read for. There are no questions. Okay. So in-house participants, maybe we pass the. Yes, we have someone here.
yeah.
Yes, my name is Hector. I'm a journalist.
You are
Hector Wu, HECTOR.
And you are
I'm a journalist.
journalist.
That's right.
So attached to which
Ghana News Service.
Ghana,
Online. That's right.
Ghana News Service. Okay.
Most of the time, the narrative has always been informed from the policymakers' perspective that the economy is robust and resilient. I would want to ask, from your perspective as experts, how robust and how resilient is the economy? Thank you.
Maybe we'll take another question. We'll take two more.
Oh, depends.
But
That's
let's
why
take
that's
two more and
when
see. Yes, the next person.
Thank you.
Introduce yourself first.
My name is Partner Utrawa. Thank you, Dr. Bacha. This is probably the best lecture I've had on monetary policy ever. You are on point. Except that because you are an insider, you couldn't say the things the way you actually feel it has to be said.
I thought I was very frank.
You were, I know. It's also symptomatic of IMF staff.
Oh,
Insiders. It's only when they leave that they are able to tell what is in there. I have two questions and a comment.
okay.
What is low inflation? How low should that inflation be? And be mindful that at the height of the Korean miracle, inflation in Korea, South Korea was 40%. Second, is it low inflation or a merely stable prices? So if you have 5%, 15%, or maybe 20%, 22, 21, stable. Third, you are right, and that is my comment. You are right that inflation is a historical problem. In fact, in 1952, when Sears and Ross were contracted by the Colonial Office to look into the mechanics of inflation in Ghana, they concluded that the Ghanaian or the Gold Coast economy was inflation prone. So we have come from that history for a very long time. And I agree with you that inflation in Ghana is primarily a supply side issue. Okay. Now, this idea that raising the interest rate can curb inflation in Ghana could be a catastrophic mistake of incorrectly matching instruments to targets. The instrument is interest rate, the target is inflation, is incorrect. So if there is rice shortage because there are supply bottlenecks from Thailand, and because of that, prices are rising, then the Bank of Ghana comes in to say that I raise interest rate, so don't consume rice because there's a problem in Thailand. That's my comment. My final comment is that across the world today, the New Zealanders who introduced inflation targeting, they have amended their Central Bank Act and explicitly included in it growth and employment targets. It is a bit disheartening that the Bank of Ghana, with the highest collection of economy, can only be mandated to look at prices. I think there's a lot more going on in this economy than just prices. And it will do us a lot of good if the mandate is brought in for the Bank of Ghana. Thank you.
Do you want to go to a two? Because the second is a little bit less. Or we take the third one.
Let's take a break.
Okay.
Thank you, Dr. Fak. I'm Dr. Eyim Dake, the president of the Association of Ghana Investors. Dr. Eyim Dake.
Okay.
I'm excited to join you this day on such a very insightful engagement and debate on the monetary policy dynamics. These are issues in the industry over the years. With yourself, we have engaged on this subject matter on the IT framework, that's the inflation target framework, over the period, and express our concerns. And very insightful because going through the fundamentals to which
an IT framework should be based. And the weakness as demonstrated by you is very much revealing. And therefore you pose one particular question: should we cap the lending rates? However, there are other schools of thought that will bring about distortion in the financial market. And I bring it back because if the fundamentals to the IT framework is weak, however, we're going on a strict jacket approach for the lending rates not to be capped or in having a form of range to aid us perfect this path that we experimented over the period with its certain difficulties. We leave that to the good people of Ghana to judge, but I wish you could give a clear relationship. Since the fundamentals are weak on the IT framework, can we, by virtue of that, extrapolate and make a strong case for the capping of the lending rates? Secondly, I also wish to see a clear linkage to the unemployment situation. I know the aggregate demand that you expressed and its relations in terms of the cascading effect into the economy can be demonstrated by that. But for purpose of engagement, it will be good to have a clear statement on that subject matter with this difficulty in unemployment. When I had this invitation, I had a discussion with my team, and we did say to ourselves, a mixed method approach in this IT targeting will do us good in the basket of products that are used to determine the inflationary figures. And surprisingly, Doctor mentioned it and went on to say a micro target using the food basket as a clear example. We share in that very concept with you, and AGI in our discussion has come out with this same approach that can there be a mixed method approach, which in recent these days are called the very pragmatic approach into determining this very inflationary basket issue. Target the food basket and deploy strategic interventions that will help it reduce that 40% and see whether we can get a balance to reduce the inflationary target figures that we come in across. And therefore, we are in the same boat with you and would join you in this advocacy. You mentioned that you seek to do this quarterly. AGI will come to the table with a partnership proposal so as we could do this together for the private sector, not for any brand, but for the common good of our country. I could go on and on a number of points that you have raised. Very insightful. We'll seek to do further digest on the document you will release to us. So taking home, the mixed method approach is very crucial, and we wish you could make further pronouncement that in this mixed method approach, what sort of strategies should government adopt regarding the food basket? We currently are aware there are a number of interventions like the fertilizer subsidy intervention for planting for food and jobs. 2017, 2018, we know the bumper harvest. But what happened thereafter? Most of these products and paddy rice were exported to the neighboring countries. As we subsidize, these products are exported. What should government do in terms of some form of intervention to control the export, whilst we seek remedy in terms of that interventions, in terms of the mixed method that we have both agreed to? Thank you.
Very interesting comments from all of them. And I'm so happy to see that we seem to be well engaged with what I'm saying. Unfortunately, Bank of Ghana representatives are not here. The banks, there are no banks representatives here. Even, oh, you are here. Bank of Ghana.
Hello.
And then you are from the bank. You are from. Okay. And government representatives are not here. Yeah.
Hello.
So you don't get the message properly across. We want a debate, discourse, encourage a discourse. I'm trying to provoke the discussion. And as I said, I'm sharing my experience. I have experience. I've worked with the Bank of Ghana for a long time. I have been a member of the Monetary Policy Committee. I've been a staff of the IMF. So I'm just trying to bring my experience to bear on this issue. Now, I'm sure when I was coming to this meeting, I knew that somebody would ask me, so, but when you were part of the committee, what could you achieve? I mean, what change could you make? You get me? And I would say that, you know, being part of the committee, we work together, like we reach decisions by consensus. So my own decision cannot always, it cannot always carry weight. In any case, if you look at the Bank of Ghana, the monetary policy, the composition, we are 7 in total. 5 of them are internal staff of Bank of Ghana, and only 2 of us are external, you know, members. So you can see, and this is the changes, the reform that we need to introduce, you know, to bring, why not AGIs and all some of you onto the committee. MPC, I'm talking about MPC. You know, so we need to enlarge that committee and bring in these other key stakeholders. But let me go to the question specifically. Now, the policymakers say economy is robust and resilient. Please, that is not for me to, that's not part of my mandate today. You know, so that one, the jury is out there. You can, I can't talk much about that. You know, and now TUC, hey, a lot of, what is, when we say low inflation, what is low inflation? That's where it started from. Yeah, of course, you can't designate the same level of inflation for every country. Every economy is different. So when I showed you the table, the inflation targets, the target they set for themselves, you see that they vary. So every country, you look at your own circumstances, and then you set what you think is appropriate for you. Look at what Bank of Ghana chose, the initial target, 8.5 plus or minus 2. Why didn't they choose 5 or 3? This is because they looked at their circumstances, they said, oh, you know, we already have inflation of 10.9%. So to come down drastically is going to be a challenge. So I have always argued on the monetary policy for me whether we didn't need a more ambitious inflation target. You know, and then I'll be reminded, oh, let's wait a while. Let's wait a while. You know, but there's something called inflation threshold for each country, and you can model that and come out with something. Because even here, I know one of my researchers who is now gone to Sweden, you know, to study further. He did a study here exactly about what inflation the threshold for Ghana is. He came up with 6%. Okay, so Ghana, it looks like, you know, well, 6% doesn't mean 6% forever. You know, the 6% using the current information, but it could change as things change. Okay, so where we are far above what could be said to be low inflation is peculiar. I mean, you tell me for each country is different, but you want to have low inflation, reasonably low inflation and stable inflation. And then also you make sure that your inflation is not too high in terms of, I mean, relating to your trading partners. You have to relate to them. You see, if your inflation like Ghana, our inflation has been much higher than our trading partners, that will affect your competitiveness, will affect your currency and all that. So that you have to relate to others also. You don't just choose, you know, anything. So low and stable price, you said 1952, I found there was a state that said Ghana is inflation prone. so we haven't moved away from that. You emphasize the supply side issue. That's exactly what I'm saying. Because the framework, the IT framework is a demand management framework. You adjust the policy rate so that and then the commercial banks will adjust their lending rate. Then people will borrow less, and money supply will be less, and then inflation will be less. That's how it works. Now, how about the food and fuel and exchange rate that is shocking the economy all the time? Well, how do you respond to that? That's exactly what I'm saying, that we should adopt a more comprehensive approach, not just macro, but micro. Go into the inflation basket, the CPI, and see where the inflation is coming from. And when I work with government, tell government, look, government, if we don't deal with food, we don't do something about food, we alone cannot control inflation. Tell government, and then do something about that. You get me? Me, I am a macro economist. I'm not an agricultural economist. So I'll tell you, go and do something about food. But as to how you do it, I'm not an expert. That is up to the Ministry of Agriculture to go and do it. Because I remember when I raised these issues, even in Municipal Policy Committee, my colleagues were saying, oh, you are a supply side economist. Do you get me? You are a supply side economist. And I was reminded that, Dr. Baji, we are operating an inflation targeting framework. That's what we are operating. You know? So, exactly, it is not about supply side. You get me? And you have to conform because you have to do things by consensus. I'm not acting like I'm being a traitor. I'm just bringing out the practical difficulties of doing things. And I want to provoke discussion. I'm so happy to hear about, especially the AGI, your input and concern. They are right on point. Because you are the ones in the market, I mean, the industry. And then, yeah, you said New Zealand. That was, if you saw the list of being targeted, they were the first to adopt inflation targets as far back as I think 1990 or thereabouts. And you have said they have included growth and employment. They have, their act, the New Zealand Act. But if you go and read the Bank of Ghana Act, you will see that the primary objective is to price stability. But in addition to that, they also mentioned that the growth and all that. They said the Bank of Ghana should support government policy. It's part of their function. It's there. So it's not like we don't mention, we are not concerned about growth and employment, because as I said, every time the Monetary Policy Committee was going to reach a decision, we look at the real side of the economy also. We look at that and we balance the risk between inflation and growth, as I said before we arrive at it. So it's not like the IT completely ignores the real side. No, we take that into consideration as well. Yeah, I'm talking too much. Okay, I'm talking too much. No, here's the idea. To wake up lending rate. Please, I don't want to go there again. I suggested it and Bank of Ghana rejected it. The banks rejected it. I don't want to go there again. Because I don't see where you can support it, okay, but okay, so no, everything you said is right on point, and I agree with you.
Yeah, minutes of the policy is not published. Is it published?
No, it's not.
So, but you see, when you do that, you listen to the various of the members of the
No, you see, I joined it, and the convention was that it's not published. So when I
don't you think it should be published?
No, listen to me. When I raised it, because I know that other jurisdictions they publish it, and so that you know the views of every member of the committee. Now I was reminded that Ghana, we are not there yet. We are not that. We need to sensitize. No, they said we need to sensitize people. You get me? Because if there are some constituencies out there who are against inflation, interest rate going up. And they see that Dr. Kwache on the committee has voted in that direction. They may target you. You can, no, that's
They want to speak in one voice.
exactly.
I
would have wished that my voice, my independent voice is heard. I would have wished that. But I'm saying that the convention that has been adopted so far is that we don't publish.
Okay, I think we have a question from someone online. Let's take it.
Oh, okay.
I'm seeing it from there, so please can you read it for us?
Can I go ahead and speak?
So the question is, with regards to the issue of high interest, it requires a thorough understanding of the mechanism by which banks price risk. For instance, in the absence industry analytics to help calculate risk, so in brackets, weather, supply side, etc., banks may charge based on perception, and that has mainly been an issue. The GNCCI believes it's about time that facilitate industrial value chains to drive interest rates. And we need to understand the industry in order to provide the requisite interest to support growth of industries.
Okay, so let's take a question from here, CBG. And we make it.
Yeah, we are almost at the end of that.
Yes.
Even you, I get in the child was a John because I saw now your car from North Side and no so far. Who saw me?
All the good things you have said about was yes, I'm sorry, yeah, please bring it here.
Just a simple question. On the lending rates, my name is Chuma Kwabwa, CEO of Association of Ghana Industries. The lending rates that is offered by the banks, the analysis made clearly shows that the cost of operation is a key part of the elements coming out of the lending rates, like is the cost. So therefore, the pricing takes that into account. And you did mention that it is possible that the operational costs, sometimes their inefficiencies, are passed on to the borrower in the form of higher price. The question I have is, has there been a study? I don't know if IE has done any study on the best practices. Are there averages or percentages in terms of operational costs compared to their total turnover? That can be a benchmark that we should be looking at. If we haven't, perhaps we should start looking into it so that we can benchmark the best practices, most efficient banks in other jurisdictions.
Because when you say buying,
whether we are improving or we are not improving. Because if it's a major element in the cost of inflation, then it's an area to critically look at and ensure that we have competition and efficiency in that area that will impact on the interest rate.
Okay.
Will you take the last question?
Yeah.
No, just give opportunity to another.
Thank you. My name is Adumaku. So,
Where are you
from DCB.
from? Okay.
So, one is a quick. So there's always the assumption that inefficient costs by banks are passed on to in terms of our pricing. But what we should also consider that in terms of pricing, our cost of funds are also very key. So if you operate in an environment where wholesale funds are very high, and if you seem to have a bank, maybe vis-a-vis wholesale funds to stable funds are quite high, then the probability is that the pricing of the bank will definitely go high. So on the other side too, assuming the policy rates were to be quite low, banks will not have any alternative if the economic pricing of the economy is the interest rates are quite low. Yeah. I'm sure we will definitely price lower because the way we mobilize deposits, which is the base for our trade, will depend on what the economic pricing of that deposits are. So I tend to sometimes think that even though cost of operations might be a key, largely to me, it's based on the way we mop up deposits in the economy that drives lending rate. So it will be ideal to also see lending rates, or say in terms of the policy rate vis-a-vis wholesale rates. You tend to see that they will be quite close, or if there are differences, it will be marginal. So this is just a comment to put across. Thank you.
Okay, I think that should be our last question. Let me respond quickly. Yeah, fuel prices, somebody said, can I give a forecast? Please, I can't. It's not my area of so I can't. Then AGI, you said for AGI, he said the best practices on operational costs of banks. I think that it will be a very good idea, because we keep saying that banks' operational costs are high, they pass it on. But you are right. We haven't done any such study, but I think that's something that we can do, so that we look at, as you said, best practices across countries. Then we can forcefully make our case that banks in Ghana have exceptionally high operational costs. Yeah, I agree with you. So that's something that my research assistant, that's something that we can take. I think we should be taking on. Now, the GCB, I'm not surprised about the way you are arguing. That's how the banks, they always argue. So when you bring this thing up, you say, oh, it's cost of funds. It's cost of funds. But I showed you the graph where you pay depositors, how much you pay depositors. I showed you the gap. Your lending rate is here and you pay deposits, you pay it here. So if this spread, you get me? How do you justify that? No, please hold on. And then the bottom line is, at the end of the day, banks make such huge profits. They declare huge profits at the end of the day, despite all the high cost of funds and so on. And you do make very big profits. So the bottom line is that because you make such big profits, and you are riding on the inefficiencies and the structural, problems in the industry, and so, why can't you, lower the spreads so that you come down your profits also? Why not? So I'm not surprised that you are arguing that way. That's when I propose that we impose a cap between the policy rates and the lending rates. You people objected to it, and I was surprised that Bank of Ghana also supported it. So that's why I'm not going there anymore. If I had my way, I will impose that cap on you, the ceiling, between the lending rate and the policy rate. and then you work within it and let's see whether you make profit or not make profit. Please, I'm done.
Okay, thank you so much. And we have the chairperson. Okay,
Oh, yeah, certainly, yeah. Gender.
Okay, I'm actually from a bank as well.
Which bank?
Cow Bank. Yes, Dr. Kwachi, I think the last point you made about the banks, I had a comment earlier, but I think putting all of that into perspective, you know, when banks are actually coming out with lending rates, beyond the cost of our funds, we also have to put into perspective the risks inherent in the industries that we are lending to. So for example, you are doing, say, agribusiness, and all the risks in the agribusiness space will not allow you to even go below a certain interest rate because you might even stand the risk of tying up your NPLs at the end of the day. So that's one issue that we have to tackle seriously as a country before we can even have that, conversation about how we can impose the cap that you just described. Even beyond that, you know that now there is a reference rate, the Ghana reference rate, which sort of gives us some guidance in terms of how much we can go above. So that is also there. It gives the bank some guidance about, you know, how much you can lend to the market and all of those. And to go back, during COVID, when it was really difficult in the economy, if you realize most banks actually reduced lending rates to some extent, just to support economic growth. BOG sort of, you know, encouraged banks to do that. And most of us responded in a good way to sort of support the economy. So I think it's a myriad of issues that come into how we price our loans. And so when we are having the conversations, let's have them in totality, you know, having all the various facets of it. Otherwise, then it becomes one-sided somewhat for the banks as well. Thank you.
Yeah, okay, please, I have to respond. You see, this was not the main subject matter for today. That's right. But I have had occasion to discuss these issues, you know, comprehensively. You know that we had a whole roundtable on high lending rates. So we expanded on this subject. And even today, I've gone into, you know, the causes of, you know, high interest, what every party can contribute. And I mentioned this, the lack of enough safety nets, and in terms of the borrower, as you have said, borrower risks and so on. I've mentioned that they should be addressed. Okay, but so you talk about borrower risks, you take that into consideration. Yes, I know that. That's a part of your costs. You know, at the end of the day, you make too much profit. I mean, that's the bottom line. And that supports your lifestyles. You know, yeah, don't we see the difference between you and your lifestyle? I mean, don't so, yeah.
Okay, I wonderful. So we leave it to the chair to give his closing remarks. Thank you very much.
Hello. Okay. Closing remarks. After this important roundtable, we like to address the issue. Now, what do you want to take along with you? After all said and done. Now, inflation targeting. Very the conclusion there is that inflation is fueled by a multiplicity of costs. Monetary policy is not comprehensive enough, it's not robust enough for all these issues. It should be redesigned to encompass all the various issues. Particularly, if you look at the consumer price index, that's a composite index where food price, the food basket dominates. It's not working. Okay. The food basket dominates. Fuel, transportation. But then the exchange rate also becomes a very important issue. Because this country is import dependent. That's something we should get away from. And So long as we have persistent depreciation of the CD, your imports become more expensive, and the high cost of imports also feed into the consumer price index. That is imported inflation. So again, we need to design a more comprehensive and robust monetary policy. The high interest rates. Historically, this has been the case, and this has dragged the development of this country. Now, interest rates affect all of us, but those who feel it more are those who are in the export sector. Here we are now in the African Continental Free Trade Area. We are competing with many other countries. If you're an industrialist and you need to export, and you borrow money at a rate of 20%, and your competitor borrows the same amount of money at 5%, you're already out of the market. So if all the noise we are making about continental free trade area, government priority should be how to help the industries to be competitive. It should be enabling. We need enabling policy. I also heard the issue of unemployment. Again, most of the sustainable employment is generated in the private sector, not in the public sector. Therefore, again, governments to come up with policies which enable the private sector but to be competitive. In a nutshell, this is what I would like to say in conclusion. Thank you.